Imagine looking at a corporate balance sheet where a company is just burning through like roughly $2 billion more than it actually
Yeah,
makes.
yeah. You'd think that's a disaster.
Exactly. Naturally, you'd assume that business is in a full-blown financial crisis, right? But Wall Street analysts are looking at that exact same math today and slapping a 1.75 trillion, yes,
Wow.
trillion, with a T dollar price tag on it.
It's honestly unprecedented.
It really is. So, welcome to the deep dive. Today, we are cracking open the massive, highly anticipated Form S1 prospectus for SpaceX, which was officially filed on May 20th, 2026.
Finally.
Right. We are bypassing the hype to really unpack the underlying physics, the frankly wild economics, and the logistics of their target $75 billion fundraise.
And, the historical gravity of this filing is just immense. I mean, for nearly a decade, leadership figures like Gwynne Shotwell and Elon Musk fiercely guarded this company.
Yeah, they were famously private.
Very much so. They actively resisted going public because they wanted to shield their long-term multiplanetary vision from the short-term quarter-by-quarter pressures of the stock
It's
market.
a 90-day earnings cycle.
Exactly. So filing this S1 is a monumental strategic pivot. They're transitioning from this secretive private aerospace shop into a sprawling public conglomerate.
And they're expected to start trading on the NASDAQ under the ticker STCX around June 12th, right?
Yep, June 12th is the target.
So to even begin to wrap your head around a $1.75 trillion valuation, we have to kind of throw out your preconceived notions.
You really do.
If you are listening to this and still thinking of SpaceX as just a rocket company, you are misreading the board entirely. The prospectus lays out something completely different.
Yet they aren't just building vehicles anymore. The S1 explicitly organizes the company into, well, three distinct segments, revealing them to be this vertically integrated data and logistics monopoly.
Which fundamentally redefines their identity.
Completely. Let's look at the three pillars the S1 outlines. First, you have space. This is the physical logistics side, the brute force moving of mass into orbit using the Falcon rockets and Starlink.
Right, that's the classic SpaceX we know.
Right. Second, you have connectivity, which is the Starlink global satellite internet infrastructure. Yeah. And finally, you have the new wildcard segment, which is AI, driven by their recent merger with XAI.
That's the part that threw everyone for a loop.
Oh, absolutely. It outlines their massive computational ambitions.
Let me try to put this in perspective for you. It's like discovering a local delivery company doesn't just own the delivery trucks. You dig into their paperwork and find out they also paved all the roads, they own the fiber optic internet cables buried underneath those roads, and oh yeah, they built the data centers powering the entire city's grid.
That is actually a highly accurate way to visualize it. And understanding how those three completely disparate divisions connect requires first principles thinking.
Meaning you have to strip the business down to the foundational truths of physics and material costs.
Exactly. Take the AI segment, for example. Why on earth merge a frontier artificial intelligence company with a space logistics company?
Right, it sounds like a sci-fi mashup.
It does, but it makes sense because AI models require just mind-boggling amounts of compute power. And massive compute requires enormous amounts of electricity and, seamless global data routing.
So if you're listening to this and thinking, wait, why is a rocket company suddenly a frontier AI lab? You're having the exact same reaction Wall Street had.
Everyone was scratching their heads.
Yeah. But when you look at the puzzle pieces, Starlink provides the low latency global data routing, and the space segment provides the heavy lift delivery mechanism.
Because the S1 hints at a future where they deploy off-grid orbital data centers.
Orbital data centers, just wow.
I know, and the physics of that are fascinating. Down here on Earth, data centers are severely constrained by the power grid and the massive amounts of water needed for cooling.
Right, they use millions of gallons of water.
Exactly. But in space, you have uninterrupted 247 solar radiation for infinite power.
Wow, okay. But what about cooling?
Well, cooling is an incredibly complex engineering challenge in a vacuum because you can only cool via radiation, not convection. But the ambient environment is near absolute zero.
So they are basically building an ecosystem where the rockets only exist to deploy the infrastructure that powers the AI.
That's the vision.
Let's talk about the rockets for a second, though,
Yeah.
because the physics of their economic moat are wild. Let's look at the space segment and what the prospectus calls their reusability deflationary loop.
Yeah, that's a key term. I mean, traditional aerospace operated on a single-use paradigm for over half a century. They treated rockets like incredibly complex, bespoke ammunition.
Which is such a bizarre concept when you think about it. It's like running a global shipping empire, but instead of bringing your massive cargo ships back to port, you just scuttle them at the bottom of the ocean after a single trip.
Right, it's financially ruinous. And it made the cost of getting a single kilogram of mass into orbit astronomically high. Only superpower governments could afford it.
So SpaceX's core breakthrough wasn't just building a rocket.
No, it was booster recycling. By landing and reusing a Falcon 9 or a Starship booster, the marginal cost of a launch just plummets.
Because instead of paying for a whole new vehicle, you were just paying for propellant.
Exactly. Liquid oxygen and methane, which are, cheap industrial commodities, and a bit of refurbishment.
By crushing that cost, they essentially manufactured a new market that couldn't afford to exist before. Because space is infinite, but the specific low orbits you need for internet service are highly constrained.
Yeah, low Earth orbit, or LEO, has severe physical limitations. You have collision risks, the threat of orbital debris
That's sort of
cascading.
Kessler syndrome, right?
Yes, exactly. And strict international regulatory limits on who gets to broadcast on what radio spectrum.
So by driving their launch costs to the floor, SpaceX became their own primary customer.
Basically,
Yeah.
yeah. They are launching nearly every 2 days now, deploying over 7,000 Starlink satellites by 2026.
Which is insane volume.
It is. They simply got there first and fastest, effectively claiming the prime orbital real estate before competitors could even, build their rockets.
Okay, so we see the three heads of this Titan space, connectivity, and AI. Now we really need to follow the money because looking at the 2025 financials in this prospectus feels like trying to read a foreign language.
Oh, it is a massive financial tug of war. It is a company of extreme contradictions.
How so?
Well, one division is a flawless cash engine, and the other two are historic cash drains.
I see numbers like this and my eyes just glaze over, so let's break it down for everyone. In 2025, they did $18.76 billion in total revenue.
Which is massive scale.
Huge. But they posted a consolidated operating loss of $2.59 billion. Yet simultaneously, they report an adjusted EBITDA of $6.58 billion.
Right.
How can a company be wildly profitable by one metric and deeply in the red on the exact same accounting document?
To understand that, we have to look at capital expenditure, or CapEx. Think of it like a neighborhood bakery.
Okay, I'm tracking.
The daily profit on selling cupcakes, which is basically what EBITDA measures, the cash generated by the core operations before the accountants step in, is massive. The bakery is incredibly popular.
Selling lots of cupcakes.
Exactly. But the owners just spent millions building a state-of-the-art 10-story mega oven. That mega oven is CapEx.
Ah, I see.
On paper, their operating income looks negative because they are rapidly writing off the cost of that massive oven.
Huh.
But the underlying cupcake business is printing cash. SpaceX is doing this, just with rockets and satellites.
And the scale of their mega oven is just staggering. Total 2025 CapEx was $20.74 billion.
Yeah.
That means they spent roughly $2 billion more on infrastructure and development than they even brought in as revenue for the entire year.
So let's look at the engine funding this. Starlink generated $11.4 billion of that total revenue, producing $4.4 billion in operating income. That is a profit margin of roughly 39%.
Wait, I have to stop you there because 39% is unheard of for telecom hardware.
It really is. But it's because the unit economics don't act like hardware. They act like software.
What do you mean?
Well, the launch business is bottlenecked by physics like how fast you can refurbish a rocket, the weather at the launch pad, the literal number of days in a year. Starlink doesn't have those bottlenecks.
Oh, because once the satellite is up there.
Right. Once the fixed cost of launching a satellite is paid, adding a new subscriber at a rural cabin or, say, on a cruise ship costs SpaceX almost nothing. It is nearly pure margin.
Wow, so Starlink is the cash cow. But then we look at the drains. The space segment brought in about $4 billion, but it is bleeding money because they are pouring capital into developing Starship.
Yeah, and then there's the AI segment. The AI division is the true black hole on the balance sheet.
How bad is it?
It posted $3.2 billion in revenue, but a catastrophic $6.4 billion operating loss. Of that total $20.74 billion in CapEx we just discussed, a full 61% of it went entirely to the AI segment.
Unbelievable. And I'm looking at this line item for the space division's R&D, and I just can't get past this number. They spent $15 billion developing Starship between 2020 and 2025.
Yeah, it's a huge number.
I don't care how you spin it, spending $15 billion on experimental rockets right before you ask Wall Street for money feels reckless. How do the underwriters even stomach that?
Well, to a traditional accountant, it looks chaotic, sure. But to an aerospace historian, it looks like the greatest bargain in human history.
A bargain. $15 billion.
Yes, because we need a baseline to understand that $15 billion. To build the Apollo program, NASA spent roughly $280 billion in inflation-adjusted money. SpaceX achieved roughly a 95% reduction in development costs.
Wait, really? A 95% discount on a moon rocket? How is that physically possible?
Through radical vertical integration and rapid iterative prototyping?
Breaking things fast.
Exactly. Traditional aerospace spends years running computer simulations to ensure the rocket works perfectly on the first try. SpaceX builds hardware incredibly fast, tests it on the launch pad until it explodes, analyzes the debris, and builds the next one.
That sounds expensive, but I guess it saves time.
Huge amounts of time. Furthermore, they aggressively control material costs. Instead of using fragile, bespoke carbon fiber that requires massive clean rooms, they pivoted to 300 series stainless steel.
Wait, isn't that the same cheap alloy used in water towers?
It is, and paradoxically, stainless steel actually gets stronger at the freezing cryogenic temperatures of liquid oxygen in space. It's heavier, but it's drastically cheaper and faster to manufacture.
Okay, so we accept they are incredibly efficient engineers, and Starlink is highly profitable, but they are still burning billions overall, largely due to that AI compute drain.
Right.
So if Wall Street banks are projecting a trillion-dollar payday based on a company burning cash, how are underwriters like Goldman Sachs and Morgan Stanley justifying a $1.75 trillion valuation?
Well, it's a math problem that demands absolute perfection. The prospectus reveals that even if SpaceX's revenue and EBITDA were to completely double next year in 2026,
Which is a huge if.
right, a 1.75 trillion valuation still implies a multiple of 56 times forward revenue and 109 times forward EBITDA.
Just for context for you listening, a high-flying tech company like Tesla trades at roughly 12 times forward revenue. Palantir is around 43 times revenue.
Yeah, there are simply no true public comparables for a business that is simultaneously a highly profitable telecom, a dominant aerospace manufacturer, and a loss-making frontier AI lab.
So what Wall Street is essentially doing is asking you to pay today for massive, incredibly successful future businesses that simply do not exist at scale yet.
Exactly. You are buying a vision of the future, not present cash flow. The underwriters model this out in 3 scenarios.
Break those down for us.
Okay, so in a bear case, say Starlink user growth hits a ceiling, Starship development stalls, and the AI monetization fails to keep up with the massive hardware costs. You're looking at a company worth maybe $500 to $800 billion.
Which is a terrifying drop from 1.75 trillion. What does a base case look like?
A base case assumes Starlink continues its steady global expansion, Falcon rockets maintain their market monopoly, Starship becomes a usable asset, and AI improves, but remains incredibly capital heavy.
I have a valuation there.
That puts the valuation somewhere between $900 billion and $1.3 trillion.
So even in a highly successful, dominant base case, 1.75 trillion is still massively overpriced.
Yes, that $1.75 trillion number sits firmly at the upper limit of a bull case scenario.
Got it.
To justify paying that price today, you have to believe Starlink becomes a ubiquitous, high-margin global utility. You have to believe Starship flawlessly materializes to unlock a totally new orbital economy. And, crucially, you have to believe that the AI segment translates its massive compute drain into durable high-margin revenue.
I noticed the company itself claims a total addressable market, or TAM, of $28.5 trillion. But reading between the lines of the S1, that mostly seems tied to their future AI ambitions and those off-grid space data centers.
Yeah, the TAM is a statement of extreme vision, not a modelable cash flow for next year. Starlink alone, even globally dominant, cannot support a $1.75 trillion price tag. It requires flawless future execution across all 3 segments.
Okay, so let's assume you're listening to this, you've absorbed the risks, but you believe in the bull case. You want in.
Right.
How does an everyday person actually buy into an IPO of this magnitude before it hits the open market? Usually, Wall Street banks aren't just handing out primary shares to retail investors.
They usually don't. In a hot IPO, institutional investors, the massive hedge funds and mutual funds, consume 90 to 95% of the shares at the offering price.
Leaving crumbs for everyone else.
Exactly. Everyday retail investors get maybe 5 to 10% if they're lucky. But Project Apex, which is the internal name for this 21-bank syndicate led by Goldman Sachs and Morgan Stanley, features a highly unusual anomaly.
What kind of anomaly?
The reporting indicates Elon Musk is demanding up to 30% of this IPO be allocated directly to retail investors.
30%? That's huge.
Yeah. They are even hosting 1,500 global retail investors at a major pre-IPO event.
Which dramatically shifts how the stock will trade on day one. But let's talk actionable mechanics. If you want those shares, you can't just assume your everyday phone app will ping you with an invite.
No, definitely not.
You have to navigate the brokerages based on the specific banking syndicate. So where should people look?
The highest probability route for a standard retail investor is through E-Trade. Because Morgan Stanley is a lead underwriter, their retail subsidiary, E-Trade, is actively expected to handle the smaller ticket retail flow.
So E-Trade is your highest confidence avenue.
Yes, Bank of America, Citi, and UBS are also in the syndicate, but their allocations appear heavily biased toward domestic high-net-worth clients, family offices, and international distribution.
What about the massive consumer apps? Robinhood, SoFi, Fidelity, Schwab?
You need to be incredibly careful here. While Robinhood has an IPO access feature, and the others have similar tools, they're currently unconfirmed. The reporting does not show them officially in the SpaceX selling group yet. It is possible they get an allocation as the syndicate broadens, but right now, you cannot bank your strategy on them.
Good to know. Are there any other ways?
Well, if you miss the primary allocation, there is one indirect backdoor route. Platforms like SoFi and Titan offer access to the ARK Venture Fund, ticker ARKVX.
Right, Kathy Wood's fund.
Exactly. This is an actively managed fund holding private venture-backed stakes, including private shares of SpaceX. It allows a backdoor method to own a piece of the company prior to the public float, though you are buying a blended fund, not pure SpaceX.
Before anyone rushes to move their capital, though, we really have to talk about the governance risk, because the fine print here is thick. Explain what the dual-class share structure actually means for a regular person buying the stock.
It means this is not a democratic shareholder structure. The S-1 reveals Musk is retaining roughly 85.1% of the combined voting power through supervoting shares.
So you are essentially a passenger. You get the financial upside, but you have zero hands on the steering wheel. Your ability to influence corporate direction is practically non-existent.
Exactly, zero. Furthermore, the prospectus notes that roughly 1/5 of their 2025 revenue came directly from the federal government, primarily NASA and defense contracts.
That feels like a double-edged sword.
It is. You are buying into a company that operates on the bleeding edge of physics, but also on the bleeding edge of federal regulation and geopolitical risk.
Which means if political winds shift or if regulatory agencies clamp down on orbital space debris, a massive chunk of their reliable revenue could just vanish overnight.
Yes. Which brings us to the ultimate long-term risk.
Right, which leaves you with one final provocative thought to mull over, pulled directly from the risk factors deeply buried in the prospectus. SpaceX themselves explicitly warned that their most ambitious future projects, specifically those orbital AI data centers and deep space infrastructure, may never become commercially viable.
It is the ultimate question you must answer for yourself before June 12th. I mean, right now, the AI segment is burning 61% of a company's capital expenditure. They're competing against the infinite balance sheets of big tech, the Microsofts, Googles, and Amazons of the world.
Yeah.
If that AI segment fails to scale, if those orbital data centers succumb to the harsh physics of space and never materialize, what happens to that $1.75 trillion sci-fi valuation?
Exactly. It's a massive bet. And to access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community.
And if you want to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice.
Conduct your own due diligence before making investment decisions.
If you'd like to access wider topics including life and investing philosophy, please subscribe to our sister channel Deep Values. Don't forget to like this video. Much appreciated.